Are you a small business owner thinking about selling your business, but aren't sure what goes into it or how much your business is even worth? In this video, I'm going to be talking about how small businesses commonly value their business, how you might be able to estimate that yourself, and other tips on how you can prepare for sale. I'm Sean. I started Ledger Ready to help small business owners get control of their finances, learn what's most important so that they're not spending time on things that aren't the most critical to their business, but also so that they can set themselves up for success and a potentially life-changing sale. So today we're going to talk about how best to value your business, what approach might make the most sense for you, and hopefully I can make it as simple and easy to follow as I possibly can. I will do my best. Again, I'm Sean. I've been a CPA for 13 years. Most of my time spent auditing large public companies, but I've been through a lot of these situations where some companies, some clients of mine have been through a recent sale and have had to go through due diligence, and so there's a lot of insights I've gathered, from being a part of that and hearing these small business owners, the challenges they face when they're approaching a sale or even right after a sale, where they might have some continuing involvement. And so my hope is to provide some value to you and other small business owners who may need it. If you need resources or you want just some occasional tips and tricks, check out my newsletter at ledgerready.work. All right, let's jump in. How to value your small business. Let's jump in here. Okay, so there are a few different ways to value your business. I put 5 of the most common methods here into this presentation. I'm going to take you through each of them and explain there are always ways to get more accurate. Hiring a professional who is does this for a living is always the best approach to get the most accurate valuation in your business. However, depending on your size, that might not be necessary, or you might not have enough money to pay for someone like that, or it might just not make sense to you. So I'm going to take you through each of these and hopefully give you some confidence as you go into this process. So I'm going to talk through each of these. The first one, multiple of sellers' discretionary earnings, multiple being, some number that you're going to multiply times whatever your earnings are to get at a final valuation. So there's sellers' discretionary earnings, which I'll talk about, a multiple of EBITDA, a discounted cash flow methodology, asset valuation, and finally comparable sales. So let's go through each of these. Sellers' discretionary earnings. So this is the best method to use if you're a relatively small business. So think under 7 figures in total revenue. This is very similar to EBITDA. It's like a modified operating cash flow metric. So what you're going to do is you're going to start with pre-tax income. You're going to add back interest expense, depreciation, and amortization. You probably don't have amortization, so you can ignore that one for now, but interest expense and depreciation you likely do have. Possibly not interest expense unless you've had to finance a portion of your business with a loan from a bank. So what you're going to do is you're going to add back owners, or rather adjust owners' compensation to a market rate. Now, your tax accountant may have told you or guided you to pay yourself a particular amount to maximize your tax benefit. And but a potential buyer wants to know, okay, for someone who's in a similar position to you, being a CEO, what's a market rate of compensation for that person? So what you're going to do is whatever you're paying yourself as a salary from your business, you're going to adjust that to what a market rate would be for a CEO for that same position. Now, the next thing you're going to do is you're going to add back non-recurring expenses. So this would be any legal or consulting services. Those are the most common, any professional service really, because a buyer, they're going to do their own thing. They're going to back this stuff out on their own regardless through the due diligence process. So you're going to want to exclude those items. Same with any discretionary expenses. So this might be personal expenses you pay through the business, or it could be travel and entertainment for customers, things like that. So once you add back those items, you get to your discretionary earnings. Now, the next step is to figure out how much to multiply those discretionary earnings by to determine the value of your business. And this is more of an art than a science. I mean, lots of people out there, a lot of the professionals out there like to tell you like, oh, they're going to get to the right answer, but there really isn't a right answer, because your business might be more valuable and likely is more valuable to certain people than it is to others. So someone who's very good at managing businesses in your market may pay more money for your business. Or if they're trying to expand their market presence, your business might be more valuable to them if you have a lot of customers, as opposed to someone who's, just trying to dip their feet in the market or something like that. So there are standard multiples you can use, but you have to just look at your business, in general and think, okay, how long have I been in business? What's the risk present with my business, and who might I want to buy it? Because obviously you don't want your business to just fail. For many small businesses, it's like having a child. You want to see them succeed, obviously. So what I have here is some like basic industry standard multiples, just to give you an idea of what these businesses typically sell for. When you're below 7 figures in revenue, these are maybe smaller than what you might have been expecting, because you're not as established at that lower revenue threshold than these other businesses. So, it's not always worth the time for certain buyers to look at these smaller, 6-figure in revenue businesses. But these are some basic multiples that you can look at based on the type of business that you're in. Now, like I said, you're going to want to adjust these for certain things specific to your business. So, for example, if you're significantly involved as the owner, that makes for higher risk for a buyer, because once they take you out of the picture, there may be a higher likelihood that the business could fail. The number of customers is another significant risk factor. So if you have very few customers as compared to a large number of customers, it's certainly higher risk, because you have what someone would call a concentration risk. If one of those customers decides to move on to a different company, or which could happen. So after you're acquired, if they don't get the same level of service and customer service that you gave them, they might move on. Structure of accounting system, also another big one. If any potential buyer wants to be able to rely on your accounting records. So if your accounting system is a mess and there's records all over the place and it's hard to follow, that means that there's work to be done once they acquire your business to clean it up. You also want to think about growth rate. How has your company been on the decline, or has revenue been growing steadily? Team stability. Have you had employees turnover a lot, or do you have employees who have been with the company for many years? Market, is another one. Is your market on the decline, or is it like an up and coming type market? So these are some of the things you should think about when you're when you're looking at these multiples. So if you look at these risk factors and you're like, well, I'm doing pretty good, like I don't really have to be involved and I have lots of customers and things like that, then you're definitely going to be a lower risk business, which means you get a higher multiple. So higher return for any potential buyer means your company is worth more. So that's the basics of that. EBITDA is very similar to the model I just described, but this would be used for larger businesses because an EBITDA metric is standard metric. So you're assuming there aren't one-offs that need to be adjusted out of this. So you're using EBITDA because it's a very comparable metric, very easy to calculate, and allows you to quickly compare to other businesses. So EBITDA is simply pre-tax income plus interest expense plus depreciation plus amortization. Amortization is the same as depreciation, but it's for typically for something called an intangible asset. So if you acquired another business, you may have acquired a customer list from them or a trademark, from that business. Now it can only come from that. If you have a trademark, that's not something that you would have on your balance sheet. So you wouldn't have, amortization from that. It's only if you acquire somebody else. So if you acquire someone else and they have this big customer list, that customer list has inherent value. So, through that valuation process, you may have recorded an intangible for a customer list, which gets amortized. Any potential buyer, and I know I'm getting into complex accounting area here, but any potential buyer is going to exclude that along with depreciation because they're going to use their own. They're going to compute that themselves, and also interest expense. So they're going to, when they buy you, that your debt goes away and they may finance with their own debt financing, using their own rate. So that's why you're adding these things back. Now, this is like a modified operating cash flow. Obviously, there are items. It's not a perfect, measure of cash flow, of course, but this is telling someone, how much profit can I expect from this business, and then you're going to multiply, same as the seller's discretionary earnings approach, by some multiple. Now, EBITDA, like I said, is typically used for somewhat larger businesses. So those, think 1 to 10 million in annual revenue. As your business gets larger, you tend to use larger multiples. The multiples, same with the seller's discretionary earnings method, are highly subjective. But they are very important because it could be, you could have two different businesses, each with $1 million in annual revenue, but getting very, very different multiples. One maybe getting a 2x multiple versus one getting a 5x multiple. So that's a $3 million difference in the value of the business, simply based on this earning multiple. So if you're trying to figure this out and you're unsure about what to use, there are market reports available. Some of them are free, some available with subscription, and they provide industry-specific insights. So if you just search for, anything like a market report, for XYZ type business, or like something like that, there's lots and lots of analyst reports out there. A lot of companies that just simply dabble in the research of things like this. The key is to be honest with yourself about the risk inherent in your business. And because I know that the tendency is to think, well, my business is the best. I'm going to be, my business is worth way more than that guy over there, And while that's great and you want to get, the most money, the most bang for your buck, so to speak, you want to get the highest dollar, obviously. You need to be realistic when you're entering these negotiations, especially be honest with yourself, and just remember that more risk equals lower multiple. The higher the risk is inherent in your business, the lower the multiple you will have. So let's dig into that a little bit more. The next method that I wanted to talk about today was discounted cash flow. This one can get complicated real fast. But essentially what this does is it values your business based upon an estimate of your future cash flow. So think reverse compound growth. So compound growth is the idea that a dollar invested today is worth many times more in 10 years from now. So for example, if you invested $100,000 in an S&P 500 index fund, so just like some standard stock market index, the S&P 500 I think earns about say 8% on average annually. So my math isn't going to be perfect here, but after 10 years that could be worth anywhere from $185,000 to $200,000, that initial $100,000 investment. So you're doing 100,000 times 1.08, 108%, because you're growing by 8% each year, and it's going to compound each year, of course. So you're going to, in year 2, you'll have 108,000. You'll multiply that by another 1.08, and that goes up, and then eventually, 10 years later, you have billions of dollars. It just, as some people would lead you to believe. So doing a discounted cash flow is like the reverse of that. So in the compound growth situation, you're saying, here's how much money I want to invest. Here's the rate I think I can get. How much money am I going to have in, say, 10 years? Now, a discounted cash flow does the exact reverse of that. It says, okay, here's how much money you think you're going to have in 10 years. How much would I have to invest today at this required rate of return to get that money in the future? So if you say your business is going to earn $10 million over the next 10 years, and you're in some potential buyer requires a rate of return of 15%, they're going to discount that back, that 10 million by the 15%, to determine what a reasonable initial investment is for that. So in this S&P 500 investment example, if someone's saying, okay, I want 185 grand in 10 years, that's how much cash flow I think I'll get at my 8% rate, which is reasonable for the risk involved in this investment. Therefore, a $100,000 investment makes the most sense today to earn that amount of money. So in this case, what an investor is seeking to do is use that estimate of future cash flows in what their required rate of return is to determine the price of your business, how much they are willing to invest to take on that risk and earn those future cash flows. So the steps to do this are to estimate your future cash flows over 5 to 10 years. If you are unsure what the estimate would be as time stretches out, lean towards estimating fewer years. You definitely want to be as accurate as possible. You don't want someone to easily be able to poke holes in your estimate. And so if the best you can do is if you've only been in business, 5 or 6 years, and 10 years might seem like forever, especially if it's a new market, or you have a niche, or some groundbreaking product that you're just not sure where it's going to go in 10 years. So lean on a shorter time frame, but try to get between 5 and 10 years as accurately as you can. So the way you do that is you estimate a growth rate, which I'll get into, and then you take where you are at now, and you chart out the next 5 years. Then you're going to compute what's called a terminal value. So when you estimate your future cash flows for the next 5 years, obviously at the end of 5 years, or hopefully, your business isn't going to be worth nothing. It's got to be worth something. So what this discounted cash flow model assumes is that you're going to sell your business at the end of this term, and that's just how the calculation works. It's not saying you have to. It's just so I'm able to chart out accurately 5 years, and based on that performance over that time frame, I think I'd be able to sell the business for X dollars at the end of that 5 or 10 years. So that gives you all the cash flows that any potential buyer would earn after they buy your business, and similar. And like I mentioned previously, you got to determine a discount rate. So this is the rate of return required by an investor, and based upon the risk of your business. So once you determine those items, you simply do a net present value cash calculation, which is pretty simple in Excel. And that's the value of your business. So let's dig into this a little bit more. Estimating future cash flows. So the goal is to estimate your EBITDA for the next 5 to 10 years. So again, earnings before interest, taxes, depreciation, and amortization. The way you do that is you look at your historical performance, your industry outlook, and your business maturity, and you apply some growth rate to each of those years, and you want to be as accurate and realistic as possible. Now, obviously, the key to this is that you have reliable historical financials. If you have, paperwork all over the place and unrecorded bills and things like that, then your accounting records aren't going to be useful to you. So it's absolutely critical that you have a good accounting system in place and are starting with reliable numbers. Remember, garbage in, garbage out, which is a very common accounting phrase that people say. If you start with bad information, any result of a computation or estimate based upon that bad information is going to be inherently wrong because you didn't start with good information. So once you have that good foundation, good solid financials, and you have a good idea of the future industry outlook for your business, and you've taken a hard look at your business maturity and thought through, okay, am I on the decline? Am I plateauing, or am I going to see some rapid growth for the next few years? That's some of the stuff you want to think about, and that's how you estimate your growth rate going forward. Now, as a bonus here, I'd be remiss if I didn't put a Ledger Ready little plug in here. I have a forecasting tool available for download whenever you sign up to my newsletter at ledgerready.work, and that makes it very simple to forecast over any time period. Now, that tool is it has plugged in there months on the final result of the forecast, but it doesn't have to be. It can be whatever time horizons you want. You would just think of the growth rate for the inputs into that as an annual growth rather than a monthly growth. So it's, it works the same way. The math's all the same. And so you could use that to do this. And then you're going to determine a terminal value. And what I would do is just refer back to EBITDA multiple slides that we just went through, except you're going to use what your projected EBITDA is for that final year, and you're going to multiply that by your multiple. So hopefully, more money. And then you just add all that stuff up. So you chart it out over however many years that is, and then you discount it back using some rate. What is the rate? And, this can get very technical very fast. This is advanced finance and accounting for sure. The technical term for the discount rate is the weighted average cost of capital. I'm not going to get into that because you could literally spend, and I have spent an entire college course learning about this. It's not simple, and but the idea is that it is the average rate you expect to pay to finance your business through a combination of debt and equity. So if you have to, you're going to get a loan from a bank, possibly to finance your operations, and you may have some investors too that require some rate of return. So you're combining those together to some weighted average to figure out what is your cost of capital? What's your cost of initial investment to operate your business over some time horizon? Now, this, like I said, this gets very technical. There's a lot of formulas and research that gets involved in this, such as computing what's called a beta, which is essentially the risk inherent in your business, and this can be very subjective. So if you're operating a large, complex business, it might make sense for you to hire a professional to assist you with this. But if you're just trying to get like a reasonable idea of what your business is worth and you'd like to use a discounted cash flow method, you could just simply use a range of 20 to 30%, which is probably not going to be that far off from where you would end up for, a small business. And like we talked about with the multiples, but this is, somewhat inverse to that, a higher percentage discount equals more risk, which means a lower value for your business. So if someone's requiring a higher rate of return, so thinking back to that S&P 500 example, if my rate of return on that was 20%, my future cash flows would be way higher. So if you were starting with the really high, that you're going from really high to 100 grand, as opposed to 100 and, in our 8% example, 185 grand to 100 grand. So the difference between those values is much different depending on how much that rate is. So a higher rate is going to create a much bigger difference between the cumulative cash flows over the future and what your present value is. So be honest with yourself. And if you're looking at this range and you're thinking, oh, I'm 20%, or I'm you know what? No, I'm better than this. I'm 15%. I'm no risk. Be honest and think about the qualitative aspects of your business, like we talked about earlier in selecting your industry multiple, and, pick what makes the most sense for you. Be conservative. Last step, discount your cash flows. Excel has, like I said earlier, a net present value formula. You just type equals NPV, and then it'll walk you through how to do this. Essentially, you just want to chart out what your cash flows are for each period, and it will do a simple calculation for you. It will automatically assume that the cash flows come at the end of each respective period, even though, like any business, they're coming likely evenly over that period. It probably won't result in that much of a difference, but it could. But this will at least give you, a general idea of where you're at. Are you looking for a calculator built for you? If so, comment on this video and I will respond. I could easily put something together like this. I could even add it on to my forecasting spreadsheet that I already have available. But I'm not going to spend time on it unless people ask for it and need it. So let me know, comment in the video if you want it. All right. So like I said, you're just going to list out your cash flows for each year, including in the final year your terminal value. And then you're just going to use that net present value function with the discount rate you selected to compute the present value of those cash flows. And boom, that's the value of your business. Cha-cha. Let's move on. Asset-based valuation. This is pretty rare. This is best for businesses that have significant assets Or if you're liquidating and going out of business, this is what you would do. So you find out the fair value of your assets. So if you have lots of machinery, vehicles, buildings, what have you, you will likely hire an appraiser. Believe it or not, they have certified appraisers for any number of things. I've seen mine car valuations and airplanes, of course, and anything you could possibly think of. I've even seen fishing license valuations. So it goes on and on. There's someone out there who's prepared to value any number of things, So you would find out the fair value of your assets. You'd subtract your liabilities, and boom, you got your book value. So like I said, if you're selling your business and you're liquidating and going out of business, you need to figure out a liquidation value, because you're not going to get fair value. If you're liquidating and someone knows you're liquidating your business, they're not going to pay you the full amount. It's just the way it is. It's just like when a home is foreclosed upon, banks never get fair value. They always get some discounted value because people know the banks aren't in the business of holding these properties. They're just trying to sell and get out as quickly as possible. So you might have to discount those fair values a bit if you're liquidating. And that's pretty much it for the asset-based valuation. Last one, comparable sales method. This is actually not a bad way to go for most businesses, especially if there is a lot of competition in your market or recent sales of very similar businesses. There's no need to overcomplicate this process. Just like a house, so think real estate. I have the first bullet here. Whenever you're buying a house, any good real estate agent is going to look at comparable sales first. That's the first thing they're going to do. They're going to look at comparable sales in the area, and then they're going to adjust that. They're going to figure out a value. They're going to say, okay, here's all the comparable sales. Here's what they've sold for. Now, and then they're going to look at your house and they're going to say, oh, well, your house, needs some upkeep, or, these other houses we looked at had better yards or the pools or, whatever, so they might adjust your value in comparison to those other sales upwards or downwards based on, how your house compares to those. And that's how they would figure out what your sale price is. So same exact thing with your business. You look for businesses that have sold. The trouble here is that unlike homes, the sale prices aren't always public information. So usually there are analyst reports, like I mentioned earlier, industry reports that may have information on recent sales. They won't always tell you like what the business was, but like the name, I mean. But they'll tell you what industry they were in, and size and things like that. So you may be able to pay for some research. Not a huge amount of money, but you may be able to pay some amount to get access to these reports to figure out what some recent sales were. If your market doesn't have a lot of sales, you may have to expand your market area. You may even have to expand the business type to find customers, competitors or other businesses that are somewhat similar to yours. So if you're in a niche, or you're the only one in your market, you might have to expand your market. And then it just gets a little trickier to adjust your sales price because it's not a direct comp. It's similar, but you may have more or less risk. Your business may be worth more or less, depending on different things. So that's something to think about when you're looking at that method. So as I said, compute. You're gonna look at comparable sales, compute estimates, look at their multiples. How much they sold for over their EBITDA, and look at the qualitative factors, so to speak, in determining the relative risk with your business. And then you're going to pick a multiple that makes sense for you, based on how those other businesses sold. Now, before I jump into this lessons learned, I just want to say that picking one of these methods for valuing your business is probably not the best way to go. I would pick multiple methods. So what I would do is pick a EBITDA metric. So either the seller's discretionary model, the EBITDA model, pick one of those. So let's say you pick you want to go with the EBITDA model. You're between million, 10 million in revenue. You're gonna then possibly look at the discounted cash flow model. So you're just gonna do a simple multiple of your EBITDA. Then you're gonna run a discounted cash flow model that looks at how your business is going in the future. So a more forward-looking model. And you may also look at recent comparable sales, and you run through each of those and identify a reasonable sale price based on each of those models, and then potentially select a value within this range. So you'd create a range of sale prices based on each of these approaches, and then pick one that makes sense. You might see an outlier in looking at these three methods. You might find that one of the methods results in a sale price that's much higher than the others or much lower than the others. I wouldn't necessarily exclude the outlier in trying to figure this out, but I would be wary of choosing something that departs significantly from the other methods. All right, let's get into some lessons learned here. I mentioned this a little bit earlier, but I want to emphasize this. Potential buyers will place more reliance on your records, your accounting records, if they appear to be consistently prepared and they see that there is structure in place to ensure completeness and accuracy. They want to know that you've recorded everything. You're not hiding anything on purpose or by accident, and that you've recorded everything accurately. Most importantly, as is the case with accounting, you want to make sure the transactions are recorded in the right period, because a lot of these valuation techniques use recent information. And so actually the best example of this is the movie The Accountant. And the first one, where Ben Affleck's character goes in, he's hired by this company that's about to go public, and he finds that this company was fraudulently inflating their most recent year by paying cash to a fictitious vendor in previous years, and then using that cash accumulated all these years to pump up their revenue in the most recent year, so that it looks like they grew rapidly right before their IPO, and they can max out their company value. Don't do that. That's fraud. But you might do that accidentally if you don't have a sound accounting system. So you want to make sure you're getting your transactions into the right year. The due diligence process is rigorous, and you don't want them to identify something that you're not already aware of. You want to be in control and confident, and look like a professional. If you have questions about the due diligence process, I posted a video a couple weeks ago walking through this, and what to think about, what to expect from that, and what an auditor would do, because you may be required to have an audit through this process. So check that video out if you're interested in that. Your accounting records are the basis for estimating your future value. In the absence of reliable records, potential buyers may walk away altogether, or they may be forced to hire someone to determine this information. They might significantly discount the results if they don't have reliable financial information. If they're still interested in buying you, even though you don't have reliable accounting records, which I doubt would happen, but if they do, because they're just trying to acquire your customer base or something like that, you're not going to get as much money for your business, I would expect. So just be aware of that, and be honest with yourself about your strengths and your weaknesses. If they had to hire someone, what I mean by that is they'd hire an accountant most likely to do something called a compilation, which means they're going to come in, you're going to give them all your accounting records, like receipts and invoices and all this stuff, and they're going to organize it into a neat set of financial statements that are structured and can be relied upon. Those accountants aren't coming in for thousands and thousands of hours to do this, so you know your business, you should know your business better than anybody. So you're the best person to take charge in this situation and make sure that you're painting your company in the best light. How to prepare. Like I said, know your stuff. Get intimately familiar with your company's financials and historical results. Be prepared to defend your growth rate and your multiple assumptions. So if someone comes in and they say, oh, I want to pay you this, and you're like, well, hey, that's way too low. Like, I did this calculation over here and came up with this. Then you're going to start talking about multiples and growth rates applied to determining these values. So get ready, be prepared to defend how you've come up with that. Document it, write down your reasons and be ready. You should know your business better than any buyer. Like I said, like I've been saying all along, you can win these arguments. You just have to be prepared. Buyers want to be set up for success and will pay a premium for an easier transaction. Don't sleep on implementing systems into your business to make it easy for them. Make it look like they're set up for success by putting processes and procedures written down in place in your business so that there's a roadmap for any buyer to follow. Along this same vein, seek structure and routine for your employees. So make sure that your employees can run as autonomously as it makes sense for you. So try to get them to the point where they're independent, so you're not having to involve yourself in every aspect of the business. The less you do in your business, the less involvement you have, the easier it is for a potential buyer to step into your shoes. So that's the 5 examples of how best to value your business. I hope this was helpful to you. Like I said at the start, if you're interested in seeing some tools, you want some help with this, you want to learn more about what goes into preparing and selling your business, check out my newsletter at ledgerready.work. All right. Thanks for listening. I'll see you next time.